Hello everyone, welcome to lecture 3 of unit 2. Today we will be covering interest rates and term structure. So this material comes from chapter 2 of your textbook and also some supplemental material. So our learning objectives today, so far we've been talking a lot about changes in interest rates and what type of impact they have on price. Today we will actually determine or identify what actually determines these interest rates. So we'll talk about the real risk-free rate and also talk about 5 different risk premiums. We'll then move into the term structure of interest rates and discuss the yield curve and its 3 shapes, and also theories on what determines these yield curve shapes, and then we'll conclude with economic indicators. So far, we have been given a yield, so given some required return, but now let's focus on where does this yield actually come from? So what are the different components? So the required yield, or your interest rate, our required rate of return on a bond, is broken down into 6 different categories, so 6 different components. So our yield, this is what we've been using this entire last lecture, talking about the required rate of return on a bond. The first component is R sub F, which is called the risk-free rate. So this is going to be explained later on in further detail, but your R sub F is your real risk-free rate. And then we have what are called risk premiums, so extra returns that investors require, and there are 5 main ones, and these include the inflation risk premium, the default risk premium, the liquidity risk premium, the maturity risk premium, and the callable risk premium if a bond is callable. So we'll go into detail on what each one of these actually mean and what they showcase, but these are the 6 different components of your required yield on a bond. So previously we've also mentioned it as the going rate out in the market for bonds of similar risk. That's all we're talking about, the yield that we use when we value bonds. So first, let's talk about the real risk-free rate. So the real risk-free rate is the interest rate that would exist on a default-free security if no inflation were expected. So basically, it's what would exist on a security, or what would be the rate of return on a security that is default-free. So in real life, there's really no security that is 100% default risk-free, but the closest thing that we have is Treasury bills. So Treasury bills are backed by the U.S. government, and what we do is we use short-term Treasury bills as this default real risk-free rate of return. So typically it's 1 month or 3 month Treasury bills, but you can actually change the maturity of this Treasury security based on whatever the holding period is that you're analyzing. Inflation, so the definition of the real risk-free rate, so the rate that would exist on default-free security if no inflation were expected. Inflation is the increase in the price of a basket of goods and services over time. So we'll talk a little bit more about inflation here upcoming, but the first component of your yield is this real risk-free rate, and what we use is Treasury bills. And if you remember, bills are your short-term securities. In particular, we use Treasury bills that are 1 month or 3 month maturity. So the remaining 5 components of your yield are what are called risk premiums, and they are the extra returns that are required to compensate investors for additional risk. So there are 5 main risk premiums, and as I mentioned, they are inflation, default, liquidity, maturity, and call risk premiums. What we'll do now is go into detail on each one of these different premiums. The first is your inflation risk. So we just discussed what inflation is when it's an increase in the price of the basket of goods. So inflation risk arises because of the variation in the value of the cash flows from a security due to changes in purchasing power. That's what inflation focuses on, is it focuses on what a dollar can actually purchase. So is the purchasing power of a dollar increasing where you have inflation, or increasing which you would have deflation, versus increasing where you... Sorry, I'm getting backwards on that. So inflation, dealing with if our dollar can purchase more, we actually have deflation, which doesn't necessarily occur too often, or you have inflation where your dollar can purchase less. Sorry about that. So let's do a quick little couple examples here. So if investors purchase a bond on which they can realize a coupon rate of 7%, but the rate of inflation is 8%, the purchasing power of the cash flows actually falls. So remember from previous courses that your real rate of return is the rate of return that has been adjusted for inflation. In this particular scenario, just an approximation, your real rate of return would actually be a negative 1%. So your purchasing power of the dollars that you are receiving is actually decreasing 1% when you take into consideration the inflation of 8% in this example. So for bonds with fixed interest rates, so fixed coupon amounts, that's what we've been valuing so far in this unit. An investor is exposed to inflation risk because the interest rate the issuer promises to make is fixed. So if it's 7%, that 7% is fixed over the lifespan of that bond. There are also adjustable rate bonds or floating rate bonds. If you've ever heard of things called floaters, where the coupon rate it floats based on some type of index, or your principal amount will float based on some type of index. This actually decreases your inflation risk. But for our particular course so far, we have just been dealing with fixed interest rates. So for example, an investor requires a 4% increase in purchasing power in order to induce this individual to lend. She expects inflation to be 3.5% next year. What is the nominal, so the rate that has not been adjusted for anything, rate she must charge? Well, she requires 4% in purchasing power. So foregoing the use of her funds basically is what that means. To lend them to some other individual or entity. Plus, she expects inflation to be 3.5%, meaning that her purchasing power will decrease 3.5% per dollar. And so the nominal rate she must charge would be approximately, that should say 7.5%. Okay, moving on to default risk. So this is our second risk premium. Default risk is the risk that the bond issuer will fail to make its promised interest and principal payments, otherwise known as credit risk. So this is much higher for those firms that are in distress, so have financial difficulties, and this is showcased by credit scores. So we have three main bond rating agencies. We have Moody's, S&P, and Fitch. We'll discuss these bond ratings later in further detail, but that is what measures default risk, otherwise known as credit risk. So credit spread then is the part of the risk premium that is attributable to default risk. So i.e. default risk premium. So this is basically seeing what is the premium that you are requiring based on the amount of default risk that this particular security has. So with the bonds, the top rated bonds is what is AAA. So if a AAA bond is rated 4%, and then a BBB bond that's identical but just with a different default risk or a different credit risk is at 6%, your credit spread would be 2%. So the credit spread is simply the additional compensation that you require due to the event of default risk, where AAA is our top rated, very low, minimal amount of default risk. Below that, you end up having more default risk. Again, we'll talk about credit ratings in a little bit more detail later on in this unit. Next up, we have liquidity risk. So you have your liquidity risk premium. This is the risk that in order to sell the security quickly, the seller has to offer a very low price. So remember that with liquidity, it has two features. Your ability to sell, to convert an asset to cash without a substantial loss of value. So if you have to wait a while or have to sell it at a low price, then you experience what is called liquidity risk. So how do I measure liquidity risk? Well, to measure liquidity risk, you would look at the spread between the bid price and the ask price quoted by a dealer. So remember that the bid price is what the dealer is willing to buy at, and the ask price is what they're willing to sell at. And so what you have is a bid-ask spread, and they make their money on the difference between what they buy and sell. So the wider the spread, the greater the liquidity risk. So if you have a large spread between what the dealer is willing to buy at and then what the dealer is willing to sell at, it could mean that there's not a lot of buyers in the market, meaning that there's low liquidity on this particular security. So bonds with lower liquidity actually trade with higher yields because they're more difficult to sell quickly for a fair price, thus they are more risky. So in the event that you need to convert that bond into cash, it's more difficult to do so without taking a loss in value. You require a higher yield on that particular security. So next type of risk premium is the maturity risk premium. So the time to maturity is the length of time before the principal is repaid. We already discussed in the previous lecture that the longer time to maturity, the greater the price volatility. So there's more price risk with longer maturity bonds. And so the interest rate risk is higher for long-term bonds, but also you have inflation risk, which could also be higher or lower depending on inflation expectations. So do you have inflation or do you have deflation occurring? But once again, maturity risk has this other component there where it's not just greater price volatility, but you could also have higher inflation risk on these longer-term bonds. You also have what is called call risk premium. So this is very important with bonds. Many bonds include a provision that allows the issuer to retire, or another terminology would be to call all or part of the issue before the maturity date. So instead of waiting until maturity to pay that final principal payment, what they do is they call the bonds back and they retire the bonds before the actual maturity date. And this is what is called call risk. So this is the risk that a callable bond will be called when interest rates fall. So why would a company call back their bonds? So first of all, as I mentioned, a call provision within a bond allows the company to repurchase the bonds back before maturity at a given call price. So why would a call exercise ever be, or why would a call provision ever be exercised? Well, if interest rates fall, what do we know about the price of the bond? The price of the bond is actually going to go up. So let's say the bond has a par value of $1,000, interest rates go down, and the bond price jumps up to all of a sudden $1,200. Well, let's say that this bond has a call provision that allows the company to purchase the bond back at $1,100. This is what is called a call price. So what would end up happening here is the company would repurchase the bond and call the bonds at this $1,100 price, in which the investor is required to sell it back at that price. And then what they do is they refinance at the lower interest rate. So let's say when the bond was initially issued at $1,000, the interest rate was 5%, the going rate out in the market was 5%. So what they did is they set their coupons to 5%. Interest rates down in the market all of a sudden dropped to 3%. The call provision allows them to repurchase at $1,100, whereas the market rate is this $1,200. What they can do then is force the investor to sell it back at $1,100 and reissue bonds at a lower 3% coupon. So it actually works against the investor, and as a result, investors require more for this call risk. So for investors, there are 3 disadvantages to these call provisions. First, the cash flow pattern cannot be known with certainty. So is the bond going to be called or not? Also, the investor is exposed to reinvestment risk. Hopefully you remember that reinvestment risk is the concern that interest rates will drop and you will have to reinvest future cash flows at a lower interest rate. Well, in the event of a call premium or a call exercise, if the interest rates drop, the bond is going to be called, and then if you want to reinvest in the bond market at the same risk, you're going to have to invest in a bond now that is offering lower coupon rates. And then the bond's capital appreciation potential will be reduced. So capital appreciation would mean the bond price increasing in value. For example, if we take a look back at my previous example up here, although the bond price went up to $1,200, my appreciation of that, my capital appreciation potential, is actually only up to $1,100 due to that call provision that is in that particular bond's indenture, the contract. So let's get out your calculator if you don't already, and let's calculate a couple yield to calls. So this is calculating the yield on a bond if a bond's call were actually exercised. So instead of calculating yield to maturity like we've been doing, what we'll do is we'll calculate yield to maturity and then compare it to what the yield to call would be if a call provision was actually exercised. So let's consider a 10-year, 10% coupon bond with a par value of $1,000. It's currently trading for $1,212. Just to apply some terminologies from previous lectures, remember that is a premium bond. So we know that the going rate out in the market must be less than 10% if it's selling for a premium. So we know that interest rates out in the market must have gone down. The price of my bond has now gone up. We already have an idea as to what type of answer we should get for this particular problem. So the bond here has semi-annual payments. What is the yield to maturity? So if it is a 10-year bond, we know that 10 times 2 would be 20 total periods. The future value is the $1,000 lump sum amount that I receive at maturity. Previously, what we've solved for is payment, or is the price, which is the present value. Here they give it to us. One thing that we need to make sure that we pay close attention to is this negative value there for the price. That's what I would pay to buy this bond. If you do not have a negative there, you will end up getting an error in your values. You have to have at least one cash outflow. We signify the price that we pay as that cash outflow. So we pay $1,212. We receive $1,000 at maturity, our future value. The payment is 10% times 1,000, which is 100, but paid semi-annually would mean $50 payments, and we compute the IY. We get an IY of 3.5. Understanding that if our N, our payment, and our IY are all input in semi-annually, this is a semi-annual yield. So to get the annual yield, I need to multiply by 2, and I get 7.01. This is your yield to maturity. If you receive the bond and or if you buy the bond, you hold on to it until maturity. However, let's say that there is a call provision on this bond that says that the company can call the bond 7 years from now. Oftentimes, there is a deferred call on bonds that limits the possibility of the company calling the bond within the first couple of years or a first set time period. So let's say the first call date on this 10-year bond is 7 years from now, and the call price is $1,100. What is the yield to call? So if it's 7 years from now, our N is now going to be 7 years times 2 for 14 total periods. Now, when we sell the bond, instead of getting the face value amount of $1,000, we are now getting the call price of $1,100. So notice that our future value becomes what that call price is. Our price that we're paying is still the negative $1,212, and our coupon payment is still $50. So when I go and calculate the IY here, I get 3.6064. Again, this is semi-annual. So again, this is semi-annual, so I need to make sure I multiply that by 2, and I get an annual yield to call of 7.21. So regardless of what the market price is, I get whatever that call price is. That's what we were talking about, limiting our appreciation on this particular security. And you can see then that our yield to call, you can very easily calculate in the same manner. The main difference being that our future value, we're not getting the par value amount that we would typically receive if we held on to it until maturity. We're getting the call price when we are forced to sell it before its actual maturity date. So let's do another example just to practice a little bit. So here we have an 8-year 5.2% coupon bond, par value of $1,000, currently trading for $987. So once again, we know that this is a discount bond. And if it's a discount bond, we know that the going rate out in the market must have gone up. So when I calculate this yield to maturity, it must be greater than the 5.2% coupon just because of the fact that the bond is selling at a discount. So this is all hopefully review for us, but it's nice to kind of keep using this terminology and understanding the relationship between coupon rates and the going rate on the market, the yield to maturity. So here we still have a future value of $1,000 because we're holding on to it until maturity, in which we would receive the principal amount. N is 16 because there's 8 years left, 2 payments a year, 16 total payments remain. 5.2% of $1,000 is $52. Paid semi-annually would be $26 payments. And the present value is this negative value. Since I would be paying that amount. And when I calculate the IY, we know that it is a semi-annual rate. And so what do I need to do with that? I need to multiply it by 2 to get the yield to maturity, and I get a yield to maturity of 5.4. Just like I expected, greater than the 5.2%. That's another way that we could have made sure that we did not accidentally write this as our yield to maturity, because if we would have put that as our yield to maturity, we know that that is a semi-annual yield. And if you go into the problem already knowing that it should be greater than 5.2 because of the fact that it's selling at a discount, you can help eliminate that small mistake. So now let's say that this first call date is 5 years from now. So in the bond's indenture, the contract, it states that on this 8-year bond, they cannot exercise a call for the first 5 years. Now 5 years, there's a call provision after 5 years in which they can call the bond for a price of $1,052. The yield actually drops to 3.1%, which is when a call provision would be exercised. The going rate decreases, bond prices go up, and the bond is actually called. What is the yield to call? There's one piece of information here that is actually irrelevant. It doesn't matter what the drop is on the yield. We just know that the yield is going to be exercised, or the yield could be exercised 5 years from now. So let's calculate what the yield to call is if interest rates actually go down and the call is exercised. So once again, the difference being from our previous example that our future value is the call price. The N would be 10. Why is the N 10? Well, it's 5 years of payments multiplied by 2 payments a year, 10. Same payment, present value is still that negative 987. What is the yield to call in this particular example? You get a yield to call semi-annual of 3.2. Remembering that I need to multiply that by 2, it's 6.41. So yes, our yield to call is higher than the yield to maturity due to that increase in price. But once again, it is a concern because if they call this bond at this new 1,052 price, now in order to invest in bonds and receive the same and take on the same level of risk, Now I'm going to be taking on bonds that have only a 3.1% or somewhere in that ballpark coupon rate. Okay, so that's another one of our components of going into our yields would be this extra risk. Another item to consider would be exchange rate risk. So from a U.S. investor's perspective, a non-dollar denominated bond has unknown U.S. dollar cash flows, right? So it all depends on what is the conversion rate between the non-dollar denominated cash flows and the U.S. dollar. So here the U.S. dollar cash flows are dependent on the exchange rate at the time the payments are received. This is called exchange rate risk. It is the risk that unexpected change in one currency compared to another currency will cause the investor's future cash flows to be smaller. So let's say you are investing in a bond of a company that is in the UK. So your coupons are going to be paid to you in British pounds. So what you are susceptible to is the pound-dollar exchange rate. So if the pound depreciates and the dollar appreciates, your conversion results in a smaller cash flow. We'll talk about exchange rate risk in a lot more detail in Unit 3, but it is something that is relevant whenever you are investing in a security that has cash flows in another denomination than the U.S. dollar. So one other feature of bonds that is not included as an extra risk premium of the 6 that we previously mentioned would be the taxability of a bond. So the question I ask you is, are coupon payments taxed? And hopefully you know it depends. So it all depends with whether or not it is a taxable bond or a non-taxable bond, meaning is it a municipal security or a federal security, or is it a corporate security? So investors actually do not pay federal taxes on interest, so your coupons received from municipal bonds. These are issued by local governments. This is because the interest is tax exempt, and so the yield on municipal bonds is oftentimes less than taxable bonds. If it's a federal bond, you're only taxed at the federal level, so you're not taxed at the local level on a federal security. These are different things that need to go into consideration when you're purchasing a bond, because we are always concerned with the after-tax yield. Right? So if some bonds are taxed and some bonds are not, we need to take that adjustment or make the adjustment and identify whether or not what's the higher yield on an after-tax basis. We will cover this in much more depth when we get to Bond Markets 1, which is Chapter 6 of this second unit. So we will discuss this taxability feature later on. So we have now moved through the 6 different components of what goes into a yield. The more risky those different components are, the greater the yield. So again, remember, the yield is the going rate out on the market for bonds of similar risk. When I'm talking about similar risk, I'm talking about these different premiums, right, and different features of the bond as well. So how can I actually view, we turn our discussion to now, how can I actually view these interest rates on different bonds? So what we do is we start talking about term structure. This is a very prevalent term in finance, something that you want to make sure that you are familiar with, and it's called term structure of interest rates. It is a comparison of the yields on securities with different maturities, assuming default likelihood is the same. So really, in other words, you're only comparing the relationship between the length of maturity and the yield on that particular security. So let's say, for example, why is a 5-year Treasury offering 3% versus a 30-year Treasury offering 6%? Why is there a difference between those two same securities, same Treasury securities, but one has a different maturity and then as a result also has a different yield? So that's what the term structure of interest rates is. It is a comparison on the yields of these securities. A visual representation of the term structure of interest rates is what is called the yield curve. So the yield curve is a graphical representation of this term structure, and the most common yield curve is for U.S. Treasury securities. And so what it does is it plots the yields from the shortest term security of 1 month to the longest term Treasury security of 30 years. So what it does is it plots the yields on 1 month, 3 month, 6 month, 1 year, 2 year, 3 year, 5 year, 7 year, 10 year, and 30 year Treasuries. And then market analysts oftentimes use this yield curve to estimate what is inflation and the likelihood that the Fed will actually raise or reduce interest rates. So there are 3 different types of yield curve shapes. So as I'm talking about the yield curve, I have a visual of this on a later slide, but on our vertical axis, we will have the yield that these securities are offering, and on the horizontal axis, we have the maturity, the length of time until this security actually matures. On a normal sloping yield curve, it is upward sloping where long-term maturity yields are higher than short-term maturity yields. So the yields over here are higher than yields over on the left-hand side, and then your short-term yields. I'm not drawing the yields on here because I do have a chart that actually showcases what these different yields are, so I'll leave that for the next slide, 2 slides from now, I think. So if you have a normal upward sloping yield curve, this could be indication that the Fed is going to raise rates. So you would expect long-term maturity securities to actually give you a higher yield than short-term securities. Inverted yield curve means that you have downward sloping. So in this case, you have long-term yields are actually lower than short-term yields. This could be an indication that the Fed is going to reduce rates, and it also could be an indication that a recession is coming. I'm going to discuss that on the next slide. And then you could also have a flat yield curve where long-term yields actually equal short-term yields. This could be indication that the Fed is going to keep rates the same. I keep talking about the Fed changing rates, the Fed changing rates, the Fed changing rates. How does the Fed change rates? Remember from the previous unit, dealing with your open market operations. We talked about 3 different ways in which they can impact rates. This is what I'm talking about here when I say that the Fed is going to increase rates, decrease rates, keep rates the same. This is through their open market operations, if you remember from Unit 1. So real quick on this inverted yield curve, there was an article in the Wall Street Journal that discussed this inverted yield curve, and it stated that the dispersion between shorter term and longer term rates, known as the yield curve, is a crucial indicator of sentiment. Sentiment is simply how people feel about the economy, right? So investors monitor the curve closely because short-term rates have exceeded long-term ones before each recession since at least 1975. So before each recession since 1975, there has been an inverted yield curve. Now, that doesn't mean that there hasn't been an inverted yield curve without a recession, but it is certain that before each recession since at least 1975, there has been an inverted yield curve on these securities. So it is something to kind of be aware of. In the event that you see one, there is a possibility based on previous economic conditions or previous events of a recession occurring. So here's what I was talking about, the chart of my yield of the 3 different types of yield curves. As I mentioned, on the vertical side, we have our yield, the R. On the horizontal side, we have the maturity or our term. This is a normal yield curve where long-term rates are greater than short-term rates. An inverted yield curve is where long-term rates are less than short-term rates. And then you have a flat yield curve, which is just saying that long-term rates equal short-term rates. So one note, the term structure can change over time, and 2, short-term rates are often more volatile than long-term rates. You'll see sometimes that the yield curve is broken down into 3 different components, where the one component that is the same is called your real rate of return. That's the rate of return you require to forego the use of your money. You also have what is called an inflation premium, and this is what some people say causes the upward sloping yield curve, is that for longer term bonds, if inflation is occurring and your purchasing power is decreasing, you require a greater rate of return. And then the third component is what is called interest rate risk premium. What did we say interest rate risk was? The concern that interest rates will go up and the price of your bond will go down. And we talked about longer term bonds having greater interest rate risk than shorter term bonds. So as you get longer maturity, the amount of interest rate risk that you require is greater. So sometimes you'll see a discussion of the yield curve being broken down into 3 categories: the real rate of return, the inflation premium, and the interest rate risk premium. But what we'll go into next is going into more of a discussion as to why does the yield curve look the way that it does. So there are 3 main theories, and the first is what is called the unbiased expectations theory. The unbiased expectation theory says that the yield curve reflects the market's expectations of future short-term rates. So basically, if the market expects rates to rise, the yield curve will be upward sloping. If the market expects rates to decrease, then it's going to go down. If they expect it to be flat, then then there'll be a flat yield curve. So let's take a look. This unbiased expectation theory defined, or as an example, says that the long-term spot rate, so the rate 2 years from now, or in our example, is an average of the current and expected future short-term interest rates. So as I said, a 2-year bond is what we're analyzing here. So using the unbiased expectation theory would say that the 2-year bond yield would be the yield on investing in 2 successive 1-year bonds. So it's going to average the current and the expected. So it's going to average the current bond and the expected bond to identify what the 2-year bond yield should be. So let's say the 1-year bond yield is 2%, and let's say the forward 1-year bond yield, so what they expect it to be 1 year from now, is 3%. If I calculate the geometric average of these two, I get and this is simplified, a 2-year bond yield of 2.5%. So what this would say is that the yield curve is based on the expectation that the 2-year rate is going to be higher than the 1-year rate, so you end up having an upward sloping yield curve. So the one drawback of this unbiased expectations theory is that it does not explain why the yield curve is so often upward sloping. Okay, so why is the yield curve so often upward sloping? The unbiased expectation theory just simply states that if you expect the rates to rise, the yield curve is going to be upward sloping. If you expect if you expect rates to decrease, you would have downward sloping. If you expect rates to stay flat, you would have a flat sloping yield curve. So that is the unbiased expectations theory. What theory can actually explain this persistent upward sloping yield curve? That would be the liquidity premium theory. So this is theory number 2 for explaining the shape of the yield curve. So the liquidity premium theory states that longer maturity securities have greater liquidity risk. And we know it's thought that investors are typically risk averse, right? So if you're offered the exact same yield on a short-term security versus a long-term security, what would you always invest in? You would always invest in short-term bonds if you're getting the same risk as long-term bonds, so because you don't want to take on that additional risk. So the reason why it is upward sloping would be that long-term bond yields are greater than short-term bond yields because they offer an extra premium based on the liquidity of that particular security. So investors are compensated with a risk premium for investing in these long-term bonds due to the fact that these long-term bonds will probably have more liquidity risk than short-term bonds. Now, this is not always true. So not all investors prefer short-term bonds in comparison to long-term bonds. If everything were the same, there are some investors, in particular insurance companies and banks, that have long-term liabilities. Not banks, insurance companies and pension funds that have long-term liabilities in which they would rather have long-term bonds than short-term bonds. They'd rather have bonds that are maturing at some point in the future as opposed to the short-term bonds. So the liquidity premium theory simply says that longer maturity securities have greater liquidity risk. Therefore, the term structure, the yield curve, is upward sloping. Then you have the market segmentation theory is our third theory that says different investors prefer different market segments, and each market segment has its own supply and demand curve. So as I mentioned previously, insurance companies, pension funds, they prefer long-term securities. Banks prefer short-term securities. Basically, it's saying that within each market, they are going to have their own supply and demand curve and come together at equilibrium for the rate that the supply and demand curve intersects. So those are our three theories. We have our unbiased expectations theory, which is based on investor sentiment or investor expectations. We have the liquidity premium theory that states that longer term maturities have greater liquidity risk, therefore it's upward sloping. And then the market segmentation theory just basically says that the yield curve is determined by the supply and demand within each market and each market segment. In reality, what are the main influences of the shape of the yield curve? One is the expectations of future interest rate changes. So this goes along the line of our unbiased expectation theory. So if we expect an increase in interest rates, it's going to be upward sloping. Decrease in interest rates is going to be downward sloping. So this is based on what we expect the future Federal Reserve moves to be, and also what the federal government budget deficits mean for future inflation. So this is combining not just interest rates, but also inflation. And then also, pension funds and insurance companies' desire for long-term bonds actually push up prices and reduces yields relative to what we would expect from expectations alone. Okay, so this is in reality what happens with our yield curve. The last thing that I want to move into here, now that we have discussed term structure and yield curves, is thinking about, okay, how does the Fed and how it responds to economic conditions actually affect the yield curve, and how is it connected to the economic cycle? So we know that the future Fed moves impact our expectations. Well, how do these Fed reactions to economic conditions, and how is it tied to the economic cycle, and how does that actually impact our yield curve? So predicting the economic cycle, well, the business cycle is a pattern of economic growth and expansion followed by decline and contraction. This is a chart here looking at different economic cycles where you have peaks and contractions down to troughs and then expansions up to peaks. That straight line there that constantly is increasing is called your productivity line. It's a growth line. With the productivity growth line, there are no cycles. You expect your real GDP to continue to increase due to better technology, more efficiency. The business life cycle then is that wavy line that has experiences of peaks, troughs, and then back up to peaks. And what we're going to do is we're going to look at key economic indicators and can help us identify where we are in this economic cycle. Are we in a peak? Are we in a trough? Are we in contraction? Are we in expansion? And we'll look at today's cycle and see where we are currently. So what are some key economic indicators that showcase where we are in the economic cycle? One is your GDP, gross domestic product. We also look at the employment rate and also check out non-farm payrolls. We look at the consumer price index, a measure of inflation. We look at sentiment, both University of Michigan consumer sentiment and also purchasing managers index, which is a measure of business sentiment. We look at retail sales, so we're looking at consumer spending. We're looking at housing starts, which is new construction on new homes. And we're looking at durable goods orders. So durable goods are goods that have a lifespan of greater than 3 years. So you're looking at like jet engines, excavators, main equipment purchases. So our current economic indicators, 2020 Q1, our GDP actually dropped 4.8%. Unemployment rate went up 14.7%, went up to 14.7%. Inflation was at 0.3%. And then if you exclude the food and energy industry, our 1.4% core inflation. We have our consumer sentiment at 71.8. We have our purchaser managers index at 36.1. Basically anything below 50 is a negative outlook for the business sentiment. We had a change in retail sales down 8.4%. We had housing start changes down 22.3%. And we had durable goods orders down 14.4%. So we see a lot of negative values here, and what we'll see here on this next slide here is whether or not we are in an expansion or contractionary period. But before we go into the next slide, when these economic indicators actually come out, they do influence the market a lot. So one thing that you might want to start looking at, and you can find this in the Wall Street Journal, is looking at the economics area, and identifying when these different indicators come out, and then seeing what type of impact it actually has on the market. So you may want to pay attention to when these different economic indicators become available, and then just following what it has on the market, so you get a better idea as to how our market reacts to these different indicators. So with our key economic indicators, in an expansion period, everything goes up except for your unemployment rate, and in a contractionary period, everything goes down except for your unemployment rate going up. So you can clearly see that in April of 2020, when we looked at these, everything went down. Every one of our indicators actually was decreasing from the previous periods, except for unemployment, which showcases then that we were in a contractionary period due to a multitude of factors. So what happens when the economy is initially in a trough? So down in that low area, GDP growth is negative. The Fed tries to revive the economy by lowering the target Fed funds rate to ease credit. So hopefully you remember that they don't set it, they have a target, and then the Federal Open Market Committee makes sales and purchases to impact that federal funds rate. As a result, your short-term interest rates will go down, and you get a steeper yield curve and becomes highly upward sloping. Now that the economy is growing, the demand for credit is up, the demand for labor and wages is up, inflation goes up, interest rates and interest rate volatility go up, and the Fed tries to curb inflation by tightening credit by increasing short-term interest rates. This is actually the opposite of what is actually happening right now. Right now, the Fed has decided to keep interest rates low and deal with inflation being slightly above their 2% target. So we'll kind of see how this goes moving forward. But this is actually something that is the opposite of what they're actually doing right now due to the unique situation here with COVID-19. And then you also have when the economy is now growing, if these events actually happen, the yield curve flattens or becomes actually inverted. So expectations of future interest rates. Expectations of future interest rates are a big deal in the fixed income market due to the fact of how much they impact outstanding fixed income security prices. Investors use these economic variables to form expectations about the future level of the economy and interest rates. And so then when these actual values actually come out, if there are any surprises, for example, let's say inflation is higher than what everyone expected relative to the consensus, what type of impact could this have on future interest rates, and what type of impact that would have on outstanding securities, and what type of impact that would have on securities that would then be issued. So quick review of the concept. We had 6 determinants of interest rates. You had your risk-free rate and then your risk premiums. What is default risk? What is liquidity risk, and how is it measured? That's your bid-ask spread. What is the term structure of interest rates? So that's a comparison of maturity and yield. What is the yield curve? That's a visual of the term structure. What are the 3 main shapes? Normal, inverted, and flat. What are the 3 theories of the yield curve? And then we also had what are the key economic indicators. So make sure you can answer those 7 questions. Don't forget to answer your review or your check-in question on McGraw-Hill Connect, your participation attendance question, and I will talk to you all for Lecture 4 here soon. All right, thanks and have a great day.